Something extraordinary is happening in the silver market right now, and the financial mainstream is hoping you never find out. For months, they told you silver was dead, the rally was over, and precious metals belong in museums, not portfolios. They said smart investors should focus on paper assets controlled by the same institutions that failed in 2008. They laughed at stackers on financial television. They dismissed physical metal holders as outdated thinkers who don't understand modern markets. They promised their paper products would outperform real, tangible assets forever. Then, reality arrived with receipts. Silver demand just hit levels not seen in 40 years, while available inventory has dropped to historic lows that nobody in mainstream media wants to discuss. This isn't random market noise. This is not a temporary fluctuation. This is the setup before what I call the Silver Thunderation, a rare market alignment that historically precedes major price movements. Welcome to Money Mind Hub Pro, where we analyze what corporate financial media conveniently ignores. Today, I'm breaking down exactly what the data reveals, why this window appears to be narrowing rapidly, and what informed investors are considering right now while others remain completely unaware of the opportunity developing beneath the surface. Let me show you exactly what triggered this analysis and why the data deserves your immediate attention. The COMEX, the primary futures exchange for precious metals pricing, recently reported registered silver inventory has fallen to approximately 28 million ounces. To understand why this number matters, consider that global industrial demand consumes over 600 million ounces annually across solar panels, electronics, electric vehicles, medical devices, and emerging technologies. The math reveals a stunning reality. The entire registered stockpile would theoretically deplete in under 3 weeks if delivery demands accelerated significantly. Do you see the disconnect forming here? The pricing mechanism for global silver trades hundreds of millions of paper ounces daily, while physical availability shrinks to levels that raise serious questions about market structure sustainability. But the data reveals something even more significant. Commercial traders, primarily large financial institutions, currently hold substantial short positions, betting silver prices will decline. These same institutions have historically been associated with price suppression, according to multiple market analysts and documented trading patterns. Here is the critical question every investor should ask. Why would sophisticated traders bet against rising prices when supply fundamentals appear historically tight? The answer reveals either a fundamental misreading of the market or a positioning strategy that cannot be maintained indefinitely against physical reality. Either scenario suggests significant price discovery changes may be approaching faster than consensus expectations currently reflect. Let me explain precisely what creates a Silver Thunderation and why February 2026 may represent a historically significant inflection point for precious metals investors. The Thunderation pattern emerges when 3 measurable conditions align simultaneously. Physical inventory drops below levels that can comfortably meet delivery obligations, institutional short positioning reaches extreme concentrations, and industrial demand acceleration outpaces any reasonable supply response. According to publicly available data, all 3 conditions appear present in the current market structure at levels exceeding previous instances. When similar alignments occurred in early 2020, silver prices approximately doubled within 18 months. However, today's fundamental backdrop appears substantially stronger because industrial demand has structurally transformed in ways that create persistent consumption regardless of price movements. Solar panel manufacturing now requires over 160 million ounces annually, with installations growing at double-digit rates globally. Every electric vehicle contains silver in its battery connections, control systems, and charging infrastructure. Artificial intelligence, data centers, 5th-generation wireless networks, and advanced medical technologies are creating demand categories that simply did not exist at a meaningful scale 5 years ago. Here's the supply-side reality that rarely appears in mainstream analysis. Primary silver mine production has declined for 8 consecutive years, while major deposit discoveries have fallen to multi-decade lows. The industry is drawing down stockpiles accumulated over generations, and those reserves are approaching levels that historically preceded supply crisis recognition. Meanwhile, Eastern nations, including China and India, have dramatically increased precious metals imports, suggesting sophisticated buyers recognize value the Western financial establishment continues dismissing. The contrast between paper market pricing and physical market tightness has rarely been this extreme. The paper derivatives market trades theoretical silver volumes that dwarf actual available metal by multiples that strain credibility. When paper claims significantly exceed physical backing, history suggests eventual reconciliation occurs through rapid price adjustment rather than gradual transition. Previous Thunderation setups preceded gains ranging from 50 to 200%, though past performance never guarantees future results, and every investor must evaluate their own circumstances carefully. All right, let's break down the pattern that has historically repeated and reveal why understanding market psychology is your best defense against making decisions that help big institutions instead of your own wallet. You see, the large financial players, the big banks and hedge funds, they have access to the exact same supply data we just went over. They understand inventory levels and demand trends just as well as anyone, if not better. So why do trading patterns suggest they're still betting against price increases even when the fundamental data looks so strong? Well, consider this. Maybe their strategy isn't about fundamentals anymore. Maybe it's psychological. Sharp price drops create fear. And what does fear do? It generates selling, often from regular investors like us. This selling provides the perfect opportunity, the liquidity, for institutions to adjust their own positions at bargain prices, right before the fundamental reality of the market becomes obvious to everyone else. Think about it. Every alarming headline about an economic slowdown crushing demand, every analyst predicting collapsing prices, every manufactured story claiming precious metals are a relic of the past, it all serves a purpose within this psychological game. But if you watch their actions, not their words, a very different picture emerges. According to the World Gold Council, central banks around the globe have been buying gold at a record pace for 3 straight years. We're also seeing reports of billionaire investors who publicly dismiss precious metals, quietly accumulating them through private channels and family offices. And on the industrial side, major consumers are locking in long-term supply deals at premium prices because they can no longer rely on the spot market for their production needs. The gap between the public story and what institutions are actually doing has rarely been this wide. Here's a crucial point. Every short position, every bet that prices will fall, eventually has to be settled. That means either delivering the physical metal or paying cash at the current market price. As the registered inventory in places like the COMEX dwindles to levels that can't possibly cover all the potential delivery demands, the base math of the market starts to heavily favor those holding the actual physical metal, not just a paper claim on it. Now, let me be crystal clear. This is not financial advice. This is pattern recognition, based entirely on publicly available data and historical precedent. So, given this analysis, what options might be worth considering? Let's outline a framework that seems consistent with the data, but please remember it's absolutely essential that you evaluate your own financial situation, your tolerance for risk, and your investment goals before making any decisions. First, physical metal ownership. Holding coins, bars, or rounds in your direct possession completely eliminates counterparty risk. It can't be defaulted on, it can't be loaned out by someone else, and it's not affected if a financial institution fails. For those interested in adding some leverage to metal prices, established mining companies could be an option. Look for ones with proven reserves, manageable debt, and active production. Historically, these stocks can amplify metal price movements, but they also come with higher volatility and company-specific risks that you need to be aware of. If you're dealing with larger positions where storing it at home isn't practical, allocated and segregated storage through audited, professional facilities is another route. This means your specific metal is held for you, separate from everyone else's. What should you be cautious about based on how these things have performed in past crises? Paper products. This includes certain ETFs, futures contracts for non-professional traders, and unallocated accounts. Historically, all of these have faced serious challenges during supply shortages when the demand for physical delivery overwhelmed the available inventory. To reduce the risk of trying to time the market perfectly, a strategy called dollar cost averaging can be effective. This just means you invest a fixed amount regularly over time, which helps smooth out your entry price instead of trying to guess the exact bottom. So what should you be watching? Keep a close eye on further declines in COMEX inventory levels. Pay attention to delivery request patterns during the upcoming contract months, and watch for any announcements about industrial supply disruptions. And be prepared for volatility. Markets rarely move in a straight line, and you'll need conviction to hold your positions through the inevitable ups and downs. The analysis suggests that the fundamentals favor patient accumulation, but the timing and size of your position are personal decisions that only you can properly evaluate for your own circumstances. I want to take a moment to acknowledge something important. Every single person watching this who decided to research precious metals on their own, who questioned the mainstream narratives that dismiss tangible assets, who recognize that historical patterns of currency devaluation and institutional failure tend to repeat, you made a decision that required courage and independent thinking. The data we've looked at today suggests that your conviction might be nearing its validation point as the reality of low inventories increasingly clashes with the prices set in the paper markets. This Thunderation window, this rare alignment of tight supply, extreme market positioning, and accelerating demand, appears to be closing based on measurable data, not just speculation. History shows that those who position themselves thoughtfully before the situation becomes obvious to everyone are the ones who typically benefit the most from major market repricing events. Those who wait for the consensus, for everyone to agree, historically get much less favorable entry points. Again, this isn't a prediction. It's an observation of patterns that have repeated throughout monetary history. So stay informed by continuing your own research, make decisions that are right for your individual circumstances, and please share this analysis with others who value independent financial thinking over institutional narratives designed to serve interests that are not their own. Subscribe to Money Mind Hub Pro and make sure you activate notifications, because our next analysis could be just as important for your financial awareness. Like this video so the algorithm shares it with others who are seeking truth over comfortable fiction. This is Money Mind Hub Pro, reminding you that knowledge precedes opportunity. I will see you in the next one.
Quick disclaimer: this video is for educational purposes only and is not financial advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Now let's dive in.